Have you ever looked at the stock market and just, dreamed of truly transformative returns? I'm talking about the kind of gains that sound almost too good to be true, like turning a modest, say, $10,000 investment into a cool $1 million. It's a vision that definitely inspires, but for most of us, it feels a bit like winning the lottery, right? Just pure luck. Well, today we're taking a deep dive into that very idea. Our compass for this is Christopher W. Mayer's fantastic book, 100 Baggers, Stocks That Return 100 to 1 and How to Find Them. And our mission for this deep dive is pretty clear. We want to extract the core insights, the key principles from the book's introduction all the way through chapter 15. We're going to try and reveal how everyday investors like you can potentially identify and, maybe even more importantly, hold on to the kinds of stocks that deliver these extraordinary, these coveted 100-bagger returns.
It's true, yeah. 100 baggers. The term itself can sound, well, a bit far-fetched, almost like a fantasy, as you said. But what our deep dive today will show, based on Mayer's work, is that by meticulously studying historical patterns, you start to see distinct characteristics emerge from these companies. And this isn't about some, arcane financial wizardry. It genuinely is presented as an everyman's approach to investing. Fundamentally, it boils down to understanding the immense power of long-term compounding. It's really not about chasing those fleeting get-rich-quick schemes. This book sets the stage for a different way of thinking about building wealth.
Okay, so let's unpack this then, starting right at the beginning. What exactly is a 100-bagger? It's pretty much what it sounds like. A stock that gives you back $100 for every single $1 you invested. So that $10,000 we mentioned, it balloons into $1 million. Now, I know what you might be thinking. That sounds like trying to draw a royal flush in poker, like almost impossible odds. But the fascinating part, as the book shows through really extensive study, is that definite patterns do seem to emerge. It's not entirely random.
No, not random. And the origins of Mayer's own quest for these patterns are quite interesting, actually. The book itself really stems from remarks made by the seasoned investor Chuck Akre back in 2011. Akre talked about discovering this forgotten 1972 classic by Thomas Phelps called 100 to 1 in the stock market. Phelps, who was an investment manager, did this pretty astonishing analysis back then of investments that had gained 100 times their starting price. And his work profoundly shaped Akre's own investment philosophy, really helping him focus sharply on the power of compounding capital. But Peter Lynch famously talked about 10 baggers.
Right, that term is much more common.
Exactly. But Phelps really went further, pushing this idea of the truly monumental 100 baggers. That distinction itself highlights the extraordinary ambition of this investment style.
And what's just as important to grasp, I think, are the common pitfalls, the mistakes that stop most investors from ever seeing these kinds of returns. One of the biggest, and maybe the most human one, is just a lack of patience. It's simple, but hard. Investors often crave activity, right? They get bored with a stock that's just sitting there, or they lose patience if it dips. This leads to constant trading, shuffling things around. But as Phelps wisely put it, a lot of shavings don't make a good workman. It's about the end result, not just looking busy. Another critical mistake is selling good businesses way too early. Phelps was apparently dead set against this. He shared this stark example of his friend Carl Pettit, an industrialist who sold his IBM stock for what seemed like a fortune back then, $1 million, that same stake. If he'd held on, it would eventually have been worth over $2 billion.
It's $2 billion. Just imagine.
Staggering, right? A massive missed opportunity, all because he cashed out early. And then there's the trap of market timing and just general bearishness, being too negative. Phelps even admitted he missed huge opportunities himself because of what he called bear market smoke, this kind of fog that stops you seeing great buying chances. His warning, "He who lives by the sword shall perish by the sword," really hits home about the futility and the danger of constantly trying to guess market swings.
Yeah, those pitfalls really highlight why you need a specific set of ingredients for a 100-bagger. First and foremost, you need a business that's capable of achieving high growth for a very long time. That duration is key. Think about Tractor Supply, for instance. The book mentions it delivered something like 23% annual earnings growth for over 12 years to become a 100-bagger. Or Monster Beverage, which hit 100-bagger status in just a decade, driven by an incredible 50% annual growth rate.
50% a year.
Insane. Yeah. Right. Phelps also gave these really profound qualitative insights. He said to look for new methods, new materials, new products, things that genuinely improve life, solve problems, make things better, faster, cheaper. He even talked about an admirable ethical streak, suggesting focusing on companies doing good for mankind. And this requires moving beyond just the numbers on a page. Phelps said, "A situation is better than a statistic. Understanding how a company could create value in the future its unique situation, how it might unfold, that's way more important than just staring at past profit margins or PE ratios. And look, if the idea of finding a full 100-bagger feels daunting, just remember the power of compounding. Even if you only catch a part of that huge gain, the returns can still be life-changing, maybe enough to fund a comfortable retirement.
That's a critical point, yeah. That highlights the sheer scale we're talking about. And speaking of scale, Mayer's own contribution, updating Phelps's work, was a huge undertaking. It really brought these patterns into focus for a modern audience. He worked with Stephen Jones to build this massive database, 365 100 baggers between 1962 and 2014, adjusted for dividends, excluding the tiniest stocks. This wasn't trivial. The data alone apparently cost his publisher over $50,000. Now, Mayer acknowledges the Moneyball criticism. You're mainly studying the winners, which could seem like a bias. But he emphasizes the book's goal isn't statistical proof, but to derive principles that, if you apply them, genuinely increase your odds of spotting those future winners.
Exactly. And it confirms that this genuinely is an everyman's approach. You don't need that fancy MBA or finance degree. The concepts are basically common sense financial ideas mixed with a disciplined mindset. The principles Mayer lays out are, as he says, undeniably true as points of logic. They form the foundation for finding a 100-bagger, making this seemingly impossible quest feel more accessible, more grounded in sensible logic. It kind of demystifies it all.
Okay, so we've laid the groundwork. We know what a 100-bagger is, where the idea came from. Now let's talk about the core concept behind actually getting there, which sounds incredibly simple but is surprisingly difficult. Buy right and hold on. It sounds almost laughably straightforward, doesn't it? Buy a good stock, hold it, done. But trust me, as countless investors have learned the hard way, actually doing this in practice, that's where the real struggle comes in. What really hit me in the book were some of the real-life stories illustrating just how hard it is to actually hold on. Like Chris Middleman's anecdote about Berkshire Hathaway. Just imagine buying it at $80 back in December 72. Then you watch it plummet 53% down to $38 just 3 years later. And the S&P 500 index, Standard & Poor's 500, was only down about 14% in that time.
Ouch. That takes serious nerve.
Right. Most people would have just dumped it, called it a disaster. Yet, for those who held on, that $38 stock in 1975 became $223,615 eventually. Middleman himself said, "I may print out the above and frame it. It just hammers home the mental strength needed." Or think about the story of the investor who bought Potash of Saskatchewan, ticker POT, for $2 a share in 92. Made a fantastic 4 or 5 times his money in 3 years, sold it around 96. Why? Because he craved new action. It seemed like it was just treading water.
Got bored.
Exactly. The original reason for buying hadn't changed, but his patience ran out. If he'd held on just another 11 years, boom, 100-bagger. Or Boeing. An investor bought it in 1970 for $9.50 when things looked really grim for the company. Held it through wars, inflation, interest rate hikes, recessions, all those things that make you want to sell. And that initial investment became a 100-bagger plus just by holding on. As the book says, if you've done the job of picking right, you're better off holding on.
And here's where it gets really interesting, I think. To fight this very human struggle to hold on, the book introduces this brilliant little tool, or maybe a crutch, called the coffee can portfolio. This idea came from Robert Kirby, a portfolio manager at Capital Group, way back in 1984. He got the idea from the Old West practice, people putting their valuables in a coffee can and burying it under the mattress, only checking on it way later.
Right, like hiding it from yourself almost.
Exactly. The core idea is deceptively simple. You pick the absolute best stocks you can find, the ones you have the highest conviction in, and then you just let them sit, untouched, for a long, long time. Kirby famously told the story of his own wife's investment account. He managed it diligently at first, making trades, adjustments. Meanwhile, her separate personal account, which she just left completely untouched, actually outperformed his actively managed one. He called it a triumph of lethargy and sloth.
Huh. That's brilliant. It shows sometimes doing nothing is the best strategy.
It really does.
And it highlights why holding on is so incredibly hard. Think about it. Wall Street, with its quarterly earnings reports, its annual performance reviews, it conditions us to measure everything in short bursts. We're not encouraged to look at the underlying business performance over decades. Pfizer is a great example from the book. Its stock price actually fell for years, like 1946 to 49, then again 51 to 56. Clients would have called it a dog.
For sure, they'd be demanding action.
Absolutely. But the business itself was consistently profitable, earning good returns on equity, earnings climbing steadily, if unevenly. Investors who just held from 1942 to 1972 made 141 times their money, a perfect coffee can stock. And then there's the ultimate example. The Voya Corporate Leaders Trust Fund started way back in 1935. This fund bought equal amounts of stock in 30 major U.S. corporations, and get this, the rule was they could never be sold unless a company went bankrupt or got merged out of existence.
Never sell. Wow.
Never sell. Today, it still holds original names like DuPont, GE, Procter & Gamble, and their descendants like ExxonMobil from Standard Oil and Foot Locker from Woolworth. Talk about set it and forget it, taken to the absolute extreme.
That's a fascinating contrast when you look at what happened to the Massachusetts Investors Trust, MIT, started in 1924. It was the world's first open-ended mutual fund. MIT promised transparency, low costs, and a buy-and-hold approach. In 1949, their average holding period was 27 years. It was seen as this brilliant, simple concept.
Sounds ideal.
It did. But from Wall Street's perspective, you couldn't make money from MIT just sitting still. There were no commissions, no management fees churning away. So in 1969, MIT brought in an external manager. That was the beginning of the end. Fees shot up like 36 times higher for only a 7-fold increase in assets. The fund started trading aggressively. By 2004, BlackRock bought it, merged it, and MIT was effectively no more. It really makes you wonder, doesn't it? What does this say about the typical mutual fund today, holding maybe 160 stocks, turning them over every year? As the book says, it's not investing, but Wall Street makes money. The system wants activity.
That is a really sobering thought, and for you, the listener, it brings up a real puzzle. A reader of the book asked, how do you pick stocks for a 35-year coffee can when some estimates say 75% of the S&P 500 might be replaced by 2027? It highlights this tension, right, between the power of holding on and the fact that time can destroy even great companies. Nothing lasts forever. The urge to bail is always there, even for the legends. Warren Buffett told a story about selling Disney in '67 for a 55% gain. He later called that decision costly, given where Disney went.
Yeah, multi-billion-dollar mistake, probably.
And the ride is never smooth. Apple was a 225 bagger from its IPO through 2012, but you had to endure 2 separate 80% peak-to-trough losses. Netflix, a 60 bagger since 2002, had multiple single days where it dropped 25%, and even one stretch where it lost 80% in 4 months.
Stomach-churning stuff.
Totally. But the coffee can idea isn't about holding everything forever, especially not speculative startups. It's about committing a portion of your money you absolutely won't need for at least 10 years to establish companies you believe in. It's a way to kind of immunize yourself against those sickening ups and downs and the constant temptation to grab a quick profit or dump a temporary loser.
And it's not just an approach for optimists, despite Buffett's inherent bullishness. Even a self-proclaimed catastrophist like Barton Biggs, after studying how wealth survived WWII calamities, still recommended putting 75% of your wealth in stocks. His conclusion was pretty profound. Owning assets, owning businesses is the best long-term protection against disaster, even in completely wrecked economies. You want to be an owner.
And we hear these inspiring coffee can stories from Mayer's readers, like the person who inherited Praxair shares. $34,000 in 1998 turned into over $250,000 just by not selling.
Just doing nothing.
Or the GE stock. $3,500 grew to over $125,000. These are ordinary people showing the extraordinary power of just leaving it alone. Of course, there are always the huge misses, like selling Telefonos to Mexico after it doubled when it could have been so much more. But the Amgen story is really powerful, too. An investor made 10 bets. 9 were total busts. But the 10th, Amgen, returned 800 times the total amount invested across all 10, covering all the losses and generating huge profits. It underlines the need to pick a truly compelling story and be willing to risk that initial capital for those potential massive winners.
Yeah, and the peace of mind this approach offers is really invaluable, isn't it? It's about knowing what you own, really understanding it, and then owning it like you would a house or a rental property, not just a ticker symbol. It frees you up to live your life without constantly sweating the day-to-day, month-to-month fluctuations of your portfolio. And the focus stays on established companies, not lottery tickets. Okay, so we've wrestled with the mental game. Now let's shift gears and look at the tangible stuff, the characteristics that actually define these 100 baggers. We're diving into the studies now.
Right. And a good starting point is this informal but really insightful study called Tony's 100 Baggers. Tony, who modestly describes himself as just a guy who likes to analyze stocks, looked at 19 of these big winners and came up with 4 key conclusions. First, he found the most powerful stock moves were driven by long periods of growing earnings combined with a significant expansion in the PE ratio. Second, this PE expansion often happened when earnings growth was accelerating. Things were getting better faster. Third, he noticed that opportunities often cropped up in beaten down, forgotten stocks that were just starting to turn profitable again. And finally, Tony argued that even lofty PE ratios shouldn't automatically scare you away from holding the stock as long as that growth story was still very much intact.
This leads perfectly into what the book calls the twin engines concept. Monster Beverage is just such a vivid example of Tony's points in action. Its earnings growth went from negative to, well, monstrous. And crucially, at the same time, its PE multiple expanded dramatically from maybe 3 times earnings to over 26 times. That powerful 1-2 punch explosive earnings growth plus a rising valuation multiple, that's what launched the stock 125-fold. It's like a rocket with 2 boosters firing. Growth, growth, and more growth, as the book says. You need both engines.
Absolutely. Another great case study illustrating these twin engines is MTY Foods, a Canadian franchisor, mostly quick-service restaurants. This company hit 100-bagger status in just 10 years. It went from a tiny $5 million market cap in 2003 to 100 times that by 2013. A huge factor was Stanley Ma, the owner-operator. He became president and bought 20% of the company, bringing his total stake up to around 29%.
Real skin in the game.
Tons of it. Every incentive to make it work. MTY's success also came from a smart franchising model, using low-cost capital effectively and making strategic acquisitions. Now look at the numbers. MTY's earnings per share grew about 12.4 times. Impressive, right?
Very.
But the stock went up 100 times. Why the huge difference? Twin engines again. The PE multiple expanded from about 3.5x when it was basically left for dead to a much healthier 26x as investors recognized the growth story. So yes, you absolutely need massive earnings growth, but it's that combination, rising earnings and a higher multiple on those earnings, that creates the truly explosive returns over the long term. And in this case, long term was just a decade.
So we're talking about companies getting massively bigger, which naturally brings up the question of company size at the start. If you look at the market overall, microcaps stocks under, say, $300 million market cap actually dominate by sheer number. There are thousands of them. And what's fascinating is that many giant companies today started incredibly small. Starbucks was just one coffee bean store in Seattle. Apple famously started in a garage with a tiny investment. Subway was a single sandwich shop.
Yeah, the potential for growth from a small base is obviously huge.
But then you have the law of large numbers. Apple, which had a $766 billion market cap during the book's study period, is pretty unlikely to be a 100-bagger from that level. That would mean a $75 trillion company, which is just unrealistic. But crucially, as Monster and MTY demonstrate, you don't necessarily need to wait 20 or 30 years for a 100-bagger. Sometimes really rapid, sustained growth can get you there in just a decade.
And broadening our view a bit, there's the Motilal Oswal study on Indian 100-baggers. They looked at 47 stocks over 20 years in India. They talked about the alchemy of 5 elements: growth, return on capital, management quality, longevity, and, of course, patience. They included this great table showing the compounding rates needed to hit 100x. For example, get 21% annual return, and you're there in about 25 years, which Mayer notes is roughly the average time frame for the 100-baggers in his study. If you need it faster, say 15 years, you need a much higher 36% annual growth rate. It just reinforces that need for sustained high growth, whatever the time frame.
Okay, then there's Kevin Martelli's study on 10x return stocks. Martelli screened something like 21,000 companies and found almost 3,800 10-baggers. But he zeroed in on what he called 100 more predictable multi-bagger stocks. What did they have in common? Often top management teams making smart capital decisions, and importantly, large shareholder or entrepreneurial founders involved. He used AutoZone as this really intriguing example. It delivered a 24-bagger despite, as he put it, ho-hum revenue growth of just 2.5%.
Oh, did that manage that?
Massive stock buybacks. They powered an incredible 25% annual growth in earnings per share. It really raises the question, how much impact can strategic buybacks have, even if the top-line growth isn't stellar?
That's a great point, leading into Hewitt Heiserman Jr.'s earnings staircase study. He looks specifically at growth stocks that became multi-baggers. Heiserman points out the attractions of just buying and holding powerful growers. You defer capital gains taxes, you trade less, you don't worry about timing the market. But he also warns about a key pitfall: overpaying for growth. He uses this simple thought experiment. Company A and Company B both grow EPS from $1 to $20 over 20 years. If you buy Company A at 5 times earnings, $5 per share, you get a 100-bagger. But if you buy Company B at 50 times earnings, $50 per share, you only get a 10-bagger.
Big difference. Price matters.
Price paid absolutely matters. Ideally, you want both strong earnings growth and that rising multiple, the twin engines, for those truly explosive returns. Heiserman also rightly criticizes focusing only on earnings. Reported earnings often miss crucial things like investment in capital, they expense R&D and marketing, which are really long-term investments, and they ignore the opportunity costs of equity capital. As the book puts it, good security analysis helps you weed out the duds. It's about finding businesses that create real underlying value, not just pretty earnings numbers.
Okay, so wrapping up this section, the key takeaways for you listening are clear. Remember, you need growth and lots of it. That's repeated again and again. Ideally, you want those twin engines firing, business growth, and a rising multiple. And just as important is knowing what not to buy. You're unlikely to find a 100-bagger in a slow-growing utility stock or a massive, mature company like McDonald's or IBM today. Knowing where not to look saves a lot of time and effort. All right, so moving from the studies, what does this actually look like in the real world? Let's shift to some compelling examples from the book's analysis of those 365 actual 100-baggers. One of the first interesting findings is that no single industry dominates the list. You see retailers, beverage companies, food processors, tech firms. It's a real mix. The only thing they truly have in common, they all returned at least 100 to 1.
Yeah, and what's also quite counterintuitive is their starting size. The median sales figure for these companies when they began their 100-bagger run was about $170 million. The median market cap was around $500 million. This kind of blows up the myth that you have to find tiny, obscure companies to get these returns. These were already substantial businesses, not just, 50-cent stocks with barely any revenue.
That's surprising.
It is. And their median price-to-sales ratio was nearly 3. That suggests they weren't classically cheap based on past performance either. It really underscores the need to look forward, as the book says. Think about the potential size of the company versus where it is now. While some dominated a specific niche, like Polaris with snowmobiles, it was much more common to see companies that grew to dominate huge national or international markets, like Comcast or Aflac. Aflac's journey is a great example. Sales grew from $585 million to over $10 billion by the time it hit 100-bagger status. That's those twin engines roaring.
Okay, let's dig into some specific case studies then. Really focus on what it took to get to 100x. Let's revisit Monster Beverage. It hit 100x in under a decade and kept going to become, a 700-plus steep bagger by 2014? Incredible run. The story starts with two immigrant entrepreneurs, Hilton Schlossberg and Rodney Sachs from South Africa. They bought Hanson's Natural Soda and Apple Juice in 1992. It was a struggling juice company back then.
Right, not exactly an energy drink powerhouse yet.
Not at all. Their genius was turning it into a marketing and branding machine without doing their own manufacturing. This meant low-cost product development, quick pivots. The huge turning point was introducing Monster Energy in 2002. They learned from Red Bull's early approach. Red Bull spent heavily on marketing relative to sales. Monster focused more on building out sales and marketing infrastructure, growing from 66 sales marketing folks in 2001 to nearly 600 by 2006, and their tactics were incredibly crafty, as the book puts it. They used a WRC contract, the federal program for women, infants, and children to get exclusive shelf space for their apple juice in grocery stores. That then opened the door for all Hanson's products.
Clever backdoor entry.
Very clever. Then, when they launched the low-carb Monster, they kept the can black but changed the M logo to blue. They avoided terms like diet or sugar-free, which might seem feminine. It was an instant success, needing almost no extra promotion because the original Monster was already so popular. So you had this potent mix, rapid sales growth plus rising gross profit margins as they needed fewer promotions and partners offered concessions. The book says, for all the detailed financial analysis, the essence of the deal is right here. And here's the kicker. Very few people followed the story early on. Even the sophisticated Value Investors Club had a top short seller betting against Hanson's in 2005 at around $6. 12 months later, it was $26. You needed that independent conviction.
Amazon is another fascinating one, obviously. 100-bagger twice over. Took 13 years for the first 100x, and that included surviving the brutal dot-com crash in the early 2000s when the stock fell into single digits. A key factor was Jeff Bezos. The book describes him as a Wall Street guy in a lot of ways. He really understood future free cash flows, capital allocation, ROIC, return on invested capital.
The underlying economics.
Exactly. And he had this relentless focus on the long term. One analyst, Thomson Clark, argued you could have made a strong fundamental case for Amazon early on. The growth runway for e-commerce was just massive, starting below 2% of retail, still only 9% by 2014. There was so much room to grow. Crucially, Amazon could have shown profits much earlier, but Bezos chose to expense R&D heavily, reinvest everything back into the business. This meant reported losses, which turned off many investors who just looked at the bottom line. He prioritized growth and dominance over short-term reported earnings.
Then there's Electronic Arts, EA. They operate in what seems like a fickle industry, tech, video games. Hits come and go. Yet EA became a 100-bagger by consistently creating hits and, crucially, securing key licenses. Profitability was sometimes erratic, but they kept pushing the right buttons. Sales grew 32 times, earnings 73 times. Key strategic decisions included bypassing distributors for better margins, experimenting with packaging, and making games for all the consoles, not betting on specific hardware. But maybe their toughest moat was getting those exclusive rights to pro sports leagues and players, Madden, NFL, FIFA, etc. Having that stable of hit franchises was huge.
Comcast provides a different kind of lesson. Its journey to 100x took nearly 18 years from its 1981 lows. What's interesting here is similar to Amazon is you didn't see smooth, steadily growing reported earnings. Comcast often showed losses because they were investing so heavily in building out their cable infrastructure. As an investor, you needed vision and tenacity, the book says, to look past the reported numbers and see the immense value in that sticky recurring revenue from subscribers.
It was all about the future potential.
Precisely. Acquisitions were also a massive part of their story, buying Group W Cable, Scripps, QVC, AT&T's cable assets, NBC Universal later on. That fueled huge sales growth, from just $20 million in '81 to over $10 billion by 2001, and then it grew 6 times more after that. And holding through the dot-com bust when the stock lost half its value still resulted in a 188-bagger for those patient enough.
Pepsi feels like a more typical 100-bagger from the list. A relatively simple business, good margins, just grew and grew into huge markets. It actually had a rough start, historically filed for bankruptcy twice early on. But from 1962, it took about 28 and a half years to hit 100x. The key was massive international expansion, 150 countries by 1985, including early moves into China and the Soviet Union. Plus strategic product launches like the Slice brand sodas and constant acquisitions, KFC, Taco Bell, Walker's Crisps, Aquafina, Tropicana. They just kept adding fuel. Its consistently high gross profit margins, often 57% or better, clearly showed its strong competitive position. Over the entire study period, PepsiCo delivered something like a 1,000-fold return.
Wow. And finally, Gillette. This one took longer, 32 years to become a 100-bagger. They absolutely dominated the razor blade market, like 70% share. Gillette's success came from a constant desire to grow, smart use of new tech like early TV ads, and just continuous improvements to their blades. Keep making it better. Their R&D created this really tough moat. The story about Wilkinson Sword introducing stainless steel blades is classic. Gillette had already patented the coating process, so Wilkinson had to pay them royalties. Then Gillette introduced its own cheaper stainless blade and solidified its dominance.
That's playing hardball.
Definitely. What's really fascinating about Gillette, though, is that its actual business quality declined over time. Profit margins fell, return on assets fell, the PE ratio collapsed. Yet because it was such a fundamentally strong, compounding business to begin with, it still became a 100-bagger. It really highlights Peter Lynch's point. A 20% grower selling at 20 times earnings is a much better buy than a 10% grower selling at 10 times earnings. Don't let a seemingly high initial multiple scare you away, because as Phelps said, good stocks are seldom without friends. There's usually a reason they command that valuation.
Okay, so that leads perfectly into the next critical element. The book argues this is maybe the single most critical ingredient for a 100-bagger. A business's ability to consistently earn high returns on its capital and effectively reinvest those returns back into the business to fuel more growth, the compounding engine itself.
It's exactly. This point is really driven home by Jason Donville from Donville Kent Asset Management. He focuses intensely on return on equity, or ROE. Just to clarify, ROE measures how much profit a business generates for every dollar of shareholder equity invested in it. It's a key measure of profitability. Donville uses Home Capital Group, HCG, a Canadian finance company, as a great example. It became a 49-bagger, not even counting dividends. Why? It consistently delivered incredible 20-30% plus annual returns on equity. So even when a stock price got hammered in 2008, cut in half during the financial crisis, if you just focused on that underlying, still strong ROE, it would have given you the conviction to hold on.
It grounds you in the business reality, not just the stock price noise.
Precisely. It echoes Phelps' example of Pfizer back in the day. Despite all the stock price ups and downs, Pfizer's steady 50-90p per cigar ROEs were the real signal of its long-term compounding power.
And this brings up the idea of the two Buffetts the book mentions. There's Buffett the first, the early Warren Buffett, who was very much a Benjamin Graham disciple looking for statistically cheap stocks, low price to book, that kind of thing, cigar butts. But then came Buffett the second, heavily influenced by Charlie Munger. He shifted focus towards the net present value of future cash flows really understanding where earnings were headed long-term and identifying sustainable competitive advantages, the moats.
Right, buying wonderful companies at fair prices, not fair companies at wonderful prices.
Exactly. And what's fascinating is that many of the 100 baggers in Mayer's study seem to fit the second Buffett model. They are predictable compounders with high sustainable ROEs. They're not usually the random rippers, like an oil company getting lucky with a discovery. You can't really plan for that kind of luck.
No, you can't. And Donville's approach offers a practical way to screen for these predictable compounders. He looks for companies that have consistently shown high ROEs, say 15% or more, for 4 or 5 years straight. And crucially, he wants to see that ROE driven by strong profit margins, not just by taking on excessive debt or leverage. But high ROE is only half the equation. The critical second piece is the capital allocation skill of the management team. How do they reinvest the profits the business generates?
That's key, isn't it? What do they do with the money?
It's absolutely crucial. Donville uses this analogy. Imagine a business earning a great 20% ROE. If management just takes those profits and sticks them in a bank account earning 2%, the company's overall ROE will actually decline over time. But if they can reinvest those profits back into the core business or into smart acquisitions at that same high rate of return, that's how you sustain the high ROE and keep the compounding machine going. It really raises the question, how many investors truly appreciate just how important that reinvestment skill is? When Donville talks to management, his main question is always, how are you investing the cash the business generates? He also looks for through-the-cycle ROE for cyclical businesses, but he generally avoids companies that actually lose money in downturns, like many mining or oil and gas stocks. He finds the sweet spot is often in smaller, high ROE businesses with fairly clear growth paths ahead. Think of an early Panera or Chipotle.
And when Donville finds these high-conviction ideas, he doesn't just take a small position, right? His fund bets big, sometimes up to 20% in a single stock. This really highlights another common thread, insider ownership. Owner-operators, people with their own money heavily invested, just naturally have stronger incentives to make smart, long-term capital allocation decisions.
Absolutely. So to sum up this vital point, the path to becoming a 100 bagger is incredibly difficult, maybe impossible, without a high ROE business that can consistently reinvest its capital at that high rate for a very long time. That internal compounding ability is the true engine.
Okay, let's pivot now from the numbers and metrics to the people driving these businesses, the owner-operators and the exceptional CEOs. The human element. The core idea here is pretty simple and intuitive. Bet with the people who have skin in the game. It reminds me of that classic Seinfeld episode where George convinces Jerry to buy a stock because the guy giving the tip, Wilkinson, supposedly has millions invested himself. You just trust it more when their own money's on the line.
Exactly. And this connects to a really fascinating market dynamic described by Peter Doyle of Horizon Kinetics concerning the rise of ETFs. Exchange-traded funds, because they need liquidity, tend to favor big, widely traded stocks. Companies that are largely controlled by insiders, founders, or families often get overlooked or underweighted by ETFs because those large insider stakes aren't readily traded. They reduce the free float.
So they're less liquid.
Right. But here's the fascinating part. Doyle argues these neglected owner-operator companies often have superior returns on capital, better underlying businesses, yet they trade at lower valuations than the big liquid stocks the ETFs are piling into. He gave the example of Simon Properties, a big mall REIT, being expensive, insiders selling, yet ETFs buying. Meanwhile, cheaper, higher-yielding property companies owned by insiders were ignored due to lower liquidity. This creates an incredible opportunity for the stock picker to find potentially better businesses at more attractive prices simply because they don't fit the ETF mold.
And there's solid evidence backing this up, right? It's not just a theory.
Oh yeah, definitely. Academic studies support it. Schulman and Noyes in 2012 found companies run by billionaires outperform the index by about 7% a year. Rudiger Fallenbrock in 2009 showed founder CEOs invest more in R&D, focus on long-term value, and tend to avoid those big, often value-destroying acquisitions. McVeigh and Dravo in 2005 found family-controlled firms often skip the quarterly earnings guidance game, focusing instead on long-term value creation, and they outperformed. The underlying belief is consistent. People with their own wealth at risk make better decisions as a group than those who are hired guns.
This philosophy is central to funds like the Virtus Wealth Masters Fund. Matt Hook, one of the managers, explained it perfectly. He said it's like having legendary investors, Buffett, Icahn, Ackman, manage your money for a reasonable fee. You get access to private equity-type talent in the public markets. They're wealth index screens for owner-operators with significant stakes. $500 in plus assets, $100 plus ownership. And historically, it outperformed the S&P 500 by about 2.7% annually over 2 decades. And you see these owner-operators acting differently. Carl Icahn strategically using his companies like chess pieces, as the book says, with American Railcar and CVR Energy. Or John Malone at Liberty Media being hyper-focused on tax efficiency, minimizing pre-tax income. That makes the stock look expensive on a simple PE basis, but it's a deliberate value-creating strategy.
Which leads us nicely to William Thorndike's fantastic book, The Outsiders: 8 Unconventional CEOs. This book really set a new standard for what great CEO performance looks like, shifting focus from sheer size or charisma, like the Jack Welch model, to capital allocation skill. And it's striking 4 of the 8 CEOs Thorndike profiled actually delivered 100 baggers or more. Henry Singleton at Teledyne 180X, Tom Murphy at Capital Cities 204X, John Malone at TCI, an incredible 900X, and of course Warren Buffett. Even others like Katharine Graham at the Washington Post, 89X, and Bill Stieritz at Ralston Purina, 52X, produced phenomenal returns.
So what was their secret sauce, according to Thorndike?
Their core shared trait was being great capital allocators. They saw their main job as skillfully using a toolkit of options, investing in operations, acquiring businesses, paying dividends, paying down debt, or buying back stock, and financing these choices smartly to maximize per-share value, not just overall company size or earnings. Their worldview was distinct. Capital allocation is paramount. Focus on cash flow over reported earnings, run decentralized organizations, think independently, buy back your own stock when it's cheap, and always minimize taxes.
Can you give some specific examples of them in action?
Sure. Henry Singleton at Teledyne is legendary. He avoided dividends, obsessed over cash flow, and bought back a staggering 90% of Teledyne stock over time. Turned $1 in 1963 into $180 by 1990. Tom Murphy at Capital Cities started with just a handful of TV and radio stations, a rowboat, as he called it, compared to CBS's ocean liner. But by focusing on cash flow, using leverage smartly, and buying back 37% of the shares, his company ended up being 3 times more valuable than CBS. $1 with Murphy became $204.
Incredible focus.
Incredible. John Malone at TCI, that 900 bagger over 25 years, 30% annual returns, while also buying back 40% of the shares. Just mind-boggling compounding. And Bill Stieritz at Ralston Purina focused intensely on ROE, used debt strategically, sold off underperforming units, and turned $1 into $57 in 19 years. Consistent themes across the board.
And these aren't just historical figures, right? Richard Cohan identified some contemporary examples still applying these outsider principles.
Exactly. Nick Howley at TransDigm making specialized aircraft parts with few substitutes, driving aggressive buyback stock was up 660% since IPO at the time of the book. Stephen and Mitchell Rales at Danaher and Colfax, masters of the folding and smaller industrials strategy. And Mark Leonard at Constellation Software doing a Danaher-like roll-up in software, buying companies, fixing them, reinvesting cash. He's known for his low profile, huge personal stake, over $400, and not issuing new shares since 2007, a 13-bagger in a fairly short time.
So while Thorndike might not be writing a sequel, the message is clear. We can invest in them by understanding these principles. Finding a great owner-operator really adds to your conviction, doesn't it? Makes it so much easier to hold on through the inevitable market turbulence.
It absolutely does. It's betting on competence, alignment, and a long-term vision. It's a huge factor.
Okay, moving towards the apex of compounding. Let's talk about what many consider the ultimate example, the gold standard, Berkshire Hathaway. We're talking an 18,000 bagger. $10,000 in 1965 becomes $180 million 50 years later. As the book says simply, the old buzzard did it.
He certainly did. And a key secret to Berkshire's success, often overlooked and highlighted by author Elena Cherkova, is its incredibly strategic use of leverage. On average, leverage made up about 37.5% of Berkshire's total capital over that period. But crucially, this wasn't typical debt. It was primarily insurance float.
Right, the premiums collected up front that they get to invest before paying claims.
Exactly. It's essentially free money, or even better than free if they underwrite profitably, that Buffett could invest masterfully. Now, Munger himself admits that even Buffett might struggle to replicate that exact success today, starting from a small base, but he still insists versions of the Berkshire system should be tried more often. The model itself is incredibly powerful.
Which leads to this modern search for the next Berkshires, these publicly traded investment holding companies. Can you explain their structure briefly?
Sure. Basically, management in these companies has broad freedom to invest across different industries, in both public and private entities. They're not tied to one specific operation. Todd Peters at Lyndhurst Alliance is one investor who focuses on these. He identified over 100 candidates and built a strategy around them. Peters draws inspiration from historical figures like Thomas Fortune Ryan, who created the first U.S. holding company back in the 19th century and became one of the richest men in America. Other influences include the Van Swaringen brothers, Allegheny, Isaac Walton Killam, the Bronfmans, who founded Brookfield Asset Management, Albert Frere in Europe. There's rich history here.
And what's Peters' investment philosophy when looking for these? Does it sound familiar?
Very familiar. It aligns perfectly with the book's themes. He wants to buy these holding companies at a discount to their underlying asset value, some of the parts. He looks for high insider ownership, owner-operator structures, strong balance sheets, low debt, basically the same qualities we've been discussing. Interestingly, he prefers holding companies based in developed markets, even if the actual businesses they own are in emerging markets, mainly for better transparency and easier access to financials. His core belief resonates strongly. Wealth creation, real wealth creation, that comes from owning and operating and building businesses and having a long-term commitment.
This raises an important question, though. Once you find these potential gems, how do the truly great investors maximize their returns? Do they just keep adding more names?
Generally, no. This is where the concept of concentration comes in, strongly advocated by Buffett. He famously dislikes the Noah's Ark way of investing. Two of everything. He says you end up with a zoo and just ensure mediocrity.
Own your best ideas, basically.
Exactly. Put meaningful amounts of money in a few things. This idea actually has a mathematical basis in the Kelly criterion, developed by physicist John L. Kelly Jr. back in 1956. The core idea is about sizing your bets based on your perceived edge or probability of success. It tells you how much to bet big on your best ideas. Now, the pure Kelly formula is known for being quite greedy. It aims for the fastest possible wealth growth, which also means high volatility.
Sounds risky.
It can be, which is why in practice, many investors use a modified version, like the half Kelly, which significantly reduces the volatility without giving up too much of the potential return. Of course, in the stock market, you can't know your exact odds like you can in blackjack. But the principle of concentrating capital on your highest conviction ideas is the key takeaway.
And Matt Peterson's Kelly Disciple slide in the book is fascinating. It shows how many top investors, people like Seth Klarman, Kyle Bass, Manish Pabrai, Bill Ackman, Prem Watsa, Bruce Berkowitz, instinctively seem to use this principle. Their public filings often show 90% or more of their portfolio concentrated in just a handful of positions.
Yeah, it's like that Minnesota Fats analogy the book uses. The legendary pool player didn't calculate physics formulas, but he internalized the principles through experience. We could say the same for these super investors. They've internalized the principle of betting big when they feel they have a significant edge.
So the message for you, the listener, is pretty stark. Reject the Noah's Ark way of investing. Keep your list of stocks relatively short. Focus your capital and your research energy on your absolute best ideas. Because as the book hammers home, when you hit that 100-bagger, you want it to matter. You want it to significantly move the needle on your overall wealth.
Absolutely. Make your winners count.
Okay, let's talk about two powerful tools companies can use. First, to potentially accelerate returns, and second, to protect those returns from competition. Stock buybacks and moats. Let's start with buybacks.
Right. The book uses this really interesting historical analogy. The tontine from 17th century France. Members pooled money, and the last survivor got the whole pot. The argument is that stock buybacks, when done right, are like modern-day tontines. As the company buys back shares, the ownership stake of the remaining shareholders increases. Future earnings, dividends, assets, everything gets concentrated among fewer owners.
So your slice of the pie gets bigger.
Exactly. However, the book is also quick to point out that buybacks are often misused. Many companies issue so many stock options to executives that the buybacks barely shrink the share count or don't shrink it at all. They just offset dilution.
But when they are done right, the results can be amazing. AutoNation is a prime example. Under Eddie Lampert's influence, they retired something like 65% of their shares. That drove a 520% return over 13 years, over 15% annually. The book calls it a slow-going private transaction in the open market. The chart showing falling shares and rising price is striking. And Lowe's Corp, run by the Tisch family, cut its share count by over 70% over 4 decades. $1 invested turned into $1,240. In a way, the book muses, these companies become more valuable by losing shareholders.
Warren Buffett offers clear criteria for when buybacks make sense. 1. The company has funds beyond its foreseeable needs. 2. The stock is selling below its intrinsic value. He wrote back in 1980 that buying back your own shares is often way more profitable than acquiring another whole company because market auctions let you buy pieces of your own business, sometimes at less than half the price you'd pay in a negotiated deal for similar earning power. While buybacks weren't as common in the earlier years of the 100-bagger study, the companies that did use them diligently often achieved spectacular results, echoing those outsider CEOs we talked about. It's definitely flagged as a potential clue for finding future 100-baggers.
Okay, now let's shift to the defense, the crucial concept of moats. What protects a business from competitors?
Right. Buffett famously popularized this analogy of a castle needing a protective moat. Phelps, in his original book, used the term gate. Same basic idea. It's a durable competitive advantage. To become a 100-bagger, a company needs to sustain high returns for a very long time. Moats are what allow them to do that, to fend off competitors and keep reinvesting profits at those high rates.
What forms can these moats take?
They come in several varieties. A strong brand can be a moat. Think Tiffany's iconic blue box, or the loyalty people have to Oreo cookies. High switching costs can be another, like with banks. Maybe the bank itself isn't that special, but the hassle of moving your account keeps you there. The network effect is very powerful. eBay is a classic example. The more buyers and sellers join, the more valuable the platform becomes for everyone. Being the low-cost producer is a huge advantage, like Southwest Airlines in its heyday. High fixed costs, but low prices make it hard for others to compete profitably. As Matthew Berry noted, the firm getting the biggest share of industry profits often has a commanding position. But it can be subtle. A great product alone, like the Chrysler minivan when it first came out, isn't necessarily a moat if competitors can copy it relatively easily. And identifying true moats can be tricky. Think Krispy Kreme versus Dunkin' Donuts. Is there really a lasting advantage?
And the book makes a really important point. Great management by itself is not a moat.
Yeah, that's a classic Buffett line. When management with the reputation for brilliance meets a company with a reputation for bad economics, it's the reputation of the company that remains intact.
So even the best CEO can't magically create a moat if the business economics aren't there.
Exactly. And moats aren't permanent. They can erode. Think about Delta Airlines, Gateway Computers, GM. They all lost their moats over time. Management can even destroy moats, like the infamous New Coke fiasco.
So how do you spot these moats? Are there financial clues?
Michael Mauboussin's idea of profit pools is helpful figuring out where the actual profits in an industry tend to accumulate. Is it the airlines or the aircraft lessors, the hotels or the online travel agents? Industry stability matters too. Moats tend to be more durable in stable industries like beverages than in rapidly changing ones like smartphones. Look how fast BlackBerry fell. But maybe the most practical financial indicator comes from Matthew Berry's unpublished study, high gross profit margins. He found this was the most important single factor of long-run performance.
Gross margins, more than net margins.
Yes, gross margins, the profit left after deducting the cost of goods sold. Berry found they are surprisingly resilient and indicate the real value a company adds for its customer, which competitors find hard to replicate. Other potential indicators include scale advantages and just a consistent track record of high-performance winners tend to remain winners.
So wrapping this up for the listener, it is great to have a moat, but true moats are rare and not so easy to identify all the time. Therefore, look for clear signs of a moat. If you have to squint too hard, maybe it isn't really there. And crucially, confirm it in the financials. Specifically, look for the higher the gross margin relative to the competition, the better. That's tangible evidence.
Good advice.
Okay, let's move into the more qualitative side now, the investor's mindset and navigating all the noise out there. Chapter 13 calls this miscellaneous mentation. It's about the behaviors that define success.
Right. And one of the first big lessons is don't chase returns and backsmark. Don't measure yourself against benchmarks. The data is pretty brutal. Most active managers fail to beat the market. In 2014, less than 20% did. Ken Hebner's CGM Focus Fund is a cautionary tale. The fund returned a great 18% a year over a decade. But the average investor in the fund only made 11%. Why? Because they pulled money out when it was down and piled in when it was up. Classic bad timing.
Buying high and selling low.
Exactly. Manish Pabrai just dismisses short-term underperformance as an irrelevant data point. Martin Whitman argued that consistently beating the market isn't even the main goal. The best investors lag 30-40% of the time anyway. Your huge advantage as an individual is you can ignore the benchmark chasing game entirely.
And then there's this fascinating idea of boredom being a carcinogenic financial killer.
Yeah, author Tom Hodgkinson argues that modern life breeds boredom, and this leads people to act like idiots with their money, sabotaging their own portfolios. Why else would someone gamble on tiny mining stocks or chase hyped-up biotechs? Because it's exciting. It feels like action, like being at a casino.
The thrill of the gamble.
Right. But this creates what Ralph Wenger called boredom arbitrage. As restless investors chase the shiny new things, patient investors can find value in the boring stocks that get left behind, selling at a discount, because they lack that entertainment factor. You avoid paying the entertainment tax.
That's a great phrase. Okay, another critical lesson. Don't get snookered. Avoid scams.
This is crucial. Carson Block, who exposed the Sino-Forest fraud, highlights systemic biases working against investors. Management incentives often favor short-termism or risky behavior. Charisma can be deceptive. Think Enron's Andrew Fastow. Block's advice: management is better seen than heard. Read old transcripts, do initiatives just disappear. That's a red flag. Boards, often just a perk, insulated from liability. Investigations can be unreliable. Lawyers represent their clients, the company, not you. Prestigious firms provide a fig leaf with dense, indecipherable language that can hide wrongdoing. Auditors, they also represent the client. They fight transparency. The saying goes, whose bread I eat, his song I sing. They rarely detect fraud. Ernst & Young missed Sino-Forest. Investment banks, their incentive is to sell products, not necessarily look out for your best interests. Market research firms, companies can pay for positive reports, fake research.
Sounds like a minefield, so what precautions can you take?
Invest with management that owns a lot of stock, especially in the U.S. where rules are clearer. Partner with successful people you trust. Stay away from weird things you don't understand. If you can't explain how they make money simply, be wary. And avoid those hot sectors where the promoters and shysters tend to gather, chasing the hype.
Okay, another major distraction to tune out. Don't believe the forecasters.
Oh yeah, Wall Street earnings estimates, often wrong by 40% or more, usually too optimistic. Only about 1 in 4 stocks gets through a year without a big negative surprise. And consensus forecasts never predict the extremes, the crashes, or the huge booms. Yet, the extremes are where you make or lose a lot of money.
They predict the average, which rarely happens.
Exactly. Benjamin Graham's slam of the financial community for trying valiantly and ineffectively to do things they can't do well, like forecasting. James Montier quipped that economists make astrologers look professional. They missed every recession for 4 decades. Howard Marks notes that extraordinary performance comes only from correct non-consensus forecasts. But those are incredibly rare. Warren Buffett, in his '94 letter, was blunt. We will continue to ignore political and economic forecasts, which are an expensive distraction. Wars, oil shocks, recessions, none of it invalidated Graham's core investing principles. The advice: hold opinions loosely, with humility. Don't bet the farm on a forecast.
What about some of the quirkier aspects mentioned?
Yeah, a few fun ones. Sosnoff's law. The price of a stock varies inversely with the thickness of its research file. Simple ideas are often best. Peter Lynch. Never invest in any idea you can't illustrate with a crayon. Beware of fixed ideas when your beliefs own you instead of you owning them. Be willing to challenge your own assumptions. Avoid grand abstractions like new economy or peak oil. These big theories often lead investors astray. Investment is the craft of the specific. Focus on the individual company. And remember, investing is a people business. Knowing what the numbers don't show can be invaluable. The book uses General Finance, GFN, as an example, a simple container leasing business. Good returns, great owner-operator. Stock sold off on cyclical fears, but the underlying earnings power from its assets and customers was still there. That requires really knowing the business, not just the spreadsheet. Find those hidden stories.
Okay, and one final worry to address. Don't worry about inflation. How can that be right?
Well, the argument is that 100 baggers are actually the best inflation fighters. Buffett wrote extensively about this early on, the Investor's Misery Index. High inflation can wipe out nominal gains after taxes. You might feel richer, but you won't eat richer. End quote. But the common wisdom that tangible assets like gold or oil are the best protection. Buffett challenged that. Asset-heavy businesses often struggle in inflation because they constantly need more capital just to stand still, earning low returns. Conversely, asset-light companies, like See's Candies, can thrive. They require very little additional capital to grow their profits, even as the value of the dollar declines. In a world of monetary depreciation, the asset-light business often wins.
That's counterintuitive, but makes sense.
And tying this all back to history, especially the Great Depression, really reinforces the core lessons and the opportunities that arise in tough times. Phelps warned about bear market smoke, blinding investors. John Maynard Keynes, nearly ruined in 1929, transformed himself. He stopped speculating and became an investor, focusing on careful selection of a few investments held for the long term. He learned to be quiet and ride out slumps with equanimity and patience. Floyd Odlum, the salvage artist, made his fortune in the Depression buying busted investment trusts for less than their cash value. His strategy: sell high, hold cash, buy low when panic strikes. Bad times create those big opportunities. David Feldman's memoir showed the brutality, but the lesson was never cry over spilt milk. Move on. Graham himself was nearly wiped out by debt in 1930, which shaped his entire philosophy. The overarching lesson for you listening: if these ideas were good enough for the Great Depression, they're good enough for whatever comes next now. And the bedrock principle underlying it all: sit on your ass, buy right, and sit tight.
That really brings us full circle. Let's try to distill everything now, returning to Charles Acker, whose insights kicked off this whole quest for underbaggers inspired by Phelps. Acker himself bagged Berkshire Hathaway, a 1,750x return for him, and American Tower. He walks the talk.
He really does. And Acker boils down his philosophy into his famous three-legged stool. It's a great summary. Leg 1, find businesses that historically compound value per share at very high rates. Leg 2, identify highly skilled managers who treat shareholders as partners. Alignment is key. And leg 3, which Acker calls the most important principle: find businesses that can reinvest their free cash flow effectively to continue earning those above-average returns. That reinvestment engine.
The compounding mechanism itself.
Exactly. He uses that powerful example. A business earning 20% ROIC, if it can reinvest its profits at that same 20% rate, $100 becomes $200 in 4 years, a six-bagger in 10 years, and hits 100x in about 25 years. Pure compounding magic. You'll also notice the absence of dividends is often an advantage, for maximum growth dividends mean less capital for the company to reinvest and trigger immediate taxes for the shareholder. And like other great investors, Acker runs a focused fund, concentrating on his best ideas. Why? Because when you find that 100-bagger, you want it to make a real difference.
Building on Acker's stool, the book then lays out 10 essential principles for finding 100 baggers. Think of this as your roadmap, distilled from everything we've covered. Number 1, you have to look for them. Sounds simple, but it means focusing your limited time and mental energy on the big game, not chasing tiny wins. Aim high from the start. Number 2, growth. Growth and more growth. It's absolutely non-negotiable. The business has to get substantially bigger, and it needs to be value-added growth, driving sales and earnings per share, not just cutting prices. Think earnings power over short-term fluctuations, like with Comcast or Amazon in their growth phases, or General Finance's underlying strength. Number 3, lower multiples preferred. Avoid paying stupid prices. Starting with a lower valuation combined with strong growth gives you those twin engines for maximum lift, like MTY Foods. That said, don't just buy cheap junk. Great businesses are rarely dirt cheap. As Munger says, long-term returns track the business's return on capital. A fair price for a wonderful business is often better than a wonderful price for a fair business. It's a balance. Number 4, economic moats are a necessity. A 100-bagger needs high returns for a long, long time. A moat protects those returns. Remember, Phelps's dividend example reinvestment fuels compounding far more powerfully. Focus on predictable compounding, not lucky strikes. Number 5, smaller companies preferred. Acorns wind up with oak trees. You generally need to start smaller to have room for 100x growth. While Apple won't do it from here due to the law of large numbers, the median 100-bagger actually started as a sizable business, $170 in sales, so you don't need tiny penny stocks. Focusing under $1 billion market cap is a reasonable starting point. Number 6, owner-operators preferred. Having that human face, a dedicated founder or family like Walton, Jobs, Bezos, Buffett, adds immense conviction. It makes holding through tough times easier. While some great companies achieve 100x without a single visionary, like Gillette, the preference for aligned owner-operators is strong. Number 7, you need time. Use the coffee can approach as a crutch. The journey is often 20-25 years. The coffee had helped you defeat impatience and that destructive need for action. Commit a portion you won't touch for at least 10 years. Let the stocks ripen. Number 8, you need a really good filter. Tune out the stock price noise and market forecasts. Remember Monster Beverage's wild price swings even as the business powered ahead. The market environment matters, but great ideas exist in any market. Keep looking. Number 9, luck helps. Let's be honest, luck plays a role. Nobody predicted the iPod. Moats can be breached unexpectedly. You have to accept uncertainty. Number 10, reluctant seller. This is absolutely paramount. Think of the Astor family. Buy and never sell. Or Ronald Reed, the janitor who built an $8 million estate by just holding quality stocks for decades and reinvesting dividends. When do you sell? Only for clear mistakes, fundamental business deterioration, or significantly better opportunities. Avoid stop losses that guarantee you'll miss the big winners by cutting them off prematurely. Monster had huge drops. As Whitman said, you make more money sitting on your ass. Learn to sit tight.
That really captures it. As the book concludes, there's no magic formula, no easy screen to find these, but these 10 principles are the distillation of what works. They guide you towards the right kinds of businesses and, just as importantly, the right kind of mindset to hold them. I wish you good fortune and hopefully many 100 baggers in your own investing journey.
What an incredible deep dive that was. The core message really resonates, doesn't it? Finding these 100 baggers isn't about some secret formula or perfect market timing. It really comes down to a disciplined mindset, truly understanding the fundamentals of the businesses you own and cultivating an almost unnatural level of patience.
Yeah, and if you connect that to the bigger picture, think about today's world. We're overloaded with information, constantly pressured for instant results, instant gratification. In that environment, maybe the greatest competitive advantage you as an individual investor actually have is simply the ability to do nothing.
Yeah.
To truly buy right and then profoundly just sit tight. It costs nothing, but requires immense self-control.
That's a powerful final thought. So for you listening, we encourage you to take these principles and apply them. What really stood out to you from today's deep dive? How might these insights actually change the way you approach your own long-term investments? Definitely something to think about. Thank you so much for joining us on another deep dive.